everyone. Thanks for joining us today. I've been introduced, so I don't need to introduce myself again. So today's talk is on property versus shares, and essentially why we believe that leveraged property is kind of in a class of its own when you consider risk versus return. And I'll talk through why we believe that. So first off, we're a regulated company, so it's important for me to say that anything that I do say in today's talk isn't specific to you and it's very general in nature. You should seek personal advice before making any changes, and it just so happens that we can help you with that on a one-to-one basis. So feel free to come and have a chat afterwards. Right, so the agenda for the talk. First off, I'll introduce us so that you understand the direction from which we're approaching this. Some of the historical returns, where we look at the different asset classes, comparing the two. To gear or not to gear, so leverage, and why that makes a massive difference. Reinvesting in liquidity, diversification, and some questions at the end if we've got time. Okay? Right, so first off us. So in a nutshell, we advise on all aspects of property investment. So firstly, helping people better understand their current situation and their goals, putting in place a suitable strategy for their specific situation, and then actually doing the research and due diligence that goes into implementing the strategy. So selecting actual properties, financing them, managing them, and then helping our clients review and reinvest when it makes sense to do so. And essentially, the focus here is on the goals rather than the asset. You know, we view property as a means to an end, a vehicle. We're not in love with property, but we like the returns that it generates and the level of risk the low level of risk that you need to take to get them. So that's essentially what we do. We help our clients make more confident and educated decisions than if they were doing it on their own. The property industry has changed. You can't just buy any property and expect to make loads of money anymore. But if you have the right strategy, you can do very, very well. So that's, in a nutshell, what we do. The reason for our service, my background is financial planning, financial advice. I run a large financial service company in Australia previous to starting Nova in the UK. And the reason for our service really is we saw a massive gap in the market between estate agents who were just trying to sell you something and financial advisors who, in the right circumstances, are quite good at advising their clients toward their goals, but they only advise on equities and pensions. They don't have the expertise or the desire to advise on property. So for people who liked property as an asset class, it was very difficult to get independent advice that you can rely upon. And that's essentially the gap that we aim to fill. Strong relationships in property is very important because it opens a lot of doors. It gives us access to the better opportunities. Our clients now buy a lot of properties, so we can leverage that to get our clients the best possible deals. So that's what we work on. We've got lots of experience. I'm personally a qualified financial advisor, mortgage advisor. I've been in the industry for 20-odd years, 15-odd years, I should say. We're all investors ourselves as well. So that's how we're able to add value to our clients' decision-making process. Right. What makes us different really is the independence. So we don't have a book or a list of properties. We don't have anything to sell. And I'm sure most of you appreciate that's important when it comes to giving advice. And there's not really anybody else in the property industry that does what we do. And I suppose that's why we've got to the stage we are quite quickly. Right. So the topic of the conversation, property versus shares, which is better? I suppose there's no sort of straight answer to that because it does depend on your situation and what you're looking to achieve as to what might be better for you. But we can look at some figures. First off, historical returns. So this graph is from a report that was generated in 2013 by a research house called Wrigglesworth. It was commissioned by Paragon Mortgages, and it looked at the returns from each asset class over an 18-year period up to 2013. So the reason for the title is that's when buy-to-let mortgages had been available for 18 years, so it's coming of age. Now what it looked at is the returns on a deposit applied for a 75% buy-to-let purchase property. So let's say, for example, you've got £50,000 and you buy a £200,000 property with a 75% mortgage. The net returns on the cash that you've applied. The average on those funds over the 18-year period was 16.3% per annum. Comparing that to cash bought property, it was 9.7. Commercial property, FTSE All Share Index, gilts and cash. So, substantially outperformed other assets. Now, when you consider you're actually buying a physical property that's not going to disappear, it's always going to have some value. And if you've bought the right property in the right area, it's pretty much always going to rent as well. So you've got a steady, reliable income. comparing that to other options on a risk-return basis, it's in a different league, in my opinion. And that's why we like property investment for most people, the broadest range of people that are looking to either create wealth or store wealth. And different types of properties generate different types of returns and are suitable for different types of people. And that's really what we help with on the selection side of things, helping people make the right decisions for them. So that's quite interesting, I think. So, as I say, which is right for you does depend on your financial position, your stage of life, your goals, and then actually putting in place the right strategy for you. But if we compare the two, property is quite good for asset-based building, so wealth creation. In the wealth creation phase of life, it's obviously quite important to build an asset base. Most people start out with a subjectively small amount of funds that they want to grow. For example, if I'm a first-time investor and I've got that £50,000, obviously I want to invest that in something that's going to grow in value so that my asset base builds. That's probably pretty straightforward, but where a lot of people can go wrong there is investing that 50 grand just for income. Now, if I'm investing it in an income-based asset, it's not going to grow. The only way I'm going to grow my asset base is by achieving growth. And a great example with property is I take that 50 grand, I buy a £200,000 asset. That asset doubles in value over an approximate 10-year period, which is about what the UK property market has done for the past 30-odd years. All of a sudden, my 50 is worth 250. My asset's worth 400, but my equity is worth 250. If I do that 4 times, I've turned 50 grand into £1 million. Now, it might seem far-fetched to turn 50 grand into £1 million, but actually, over a longer period of time, it's quite achievable. You can't really do that with any other asset class. You can't borrow at high loan-to-values, low interest rates over the long term with no ability for that lender to recall the mortgage. And I'll get onto a bit more on that in a moment. Property yields are quite strong in the right areas. So your London yields aren't great. Average yields in London are about 3.5%. Most of our clients, and personally as well, we've been buying in the Midlands and the Northwest. Areas where your yields are between 6 and 8% gross. But what we tend to focus more on is the net yield on the funds applied. So same example, I've applied 50,000 to a £200,000 asset. We'd be aiming for 10% plus net yields on the funds applied. So 5 grand plus in my pocket every year, pre-tax obviously, which is pretty good going. I don't know of many funds or shares or stocks that provide a reliable 10% net yield with also the potential for growth. Obviously the leverage strategy. So property as a cash buy isn't all that sexy. It's okay. The returns are pretty similar to cash bought shares and stocks. You're looking at sort of 6 to 10% per annum. But I just spoke there about 10% net yields. Obviously that's just the income side of the equation. If you add to that growth, if you're achieving a relatively average 5% growth per annum on that same asset I described, that's a 20% return on your cash. 200 grand grows by 5%, it's worth 210. 10 grand on my 50 is 20%. So you put the 10 with the 20, you're at over 30% per annum with a relative amount of confidence. The UK average for the past 20 years is 5.5% growth per annum. So 5 is conservative. Of course, hopefully we can do better than the average. So as I say, in no other real option can you achieve 30% returns with confidence in an asset that is physical. So that's why we like property. What shares does certainly provide is the ability for diversification and liquidity. And I'd say this is probably the main thing that people say to us when we talk, that are historically share or stocks investors, is, well, I can't spread my money as well. And the answer, and that's true, you can't really, unless you're extremely wealthy, you can't buy thousands of properties. But you don't necessarily have to. Because if you're buying the right properties in the right areas, as I say, and they're going to rent every day of the year, there's no point in diversifying just for the sake of it. And I think diversification is probably the most overused word in the financial service industry. Liquidity, property isn't liquid. That there's high entry costs. You pay stamp duty and legal fees to enter. You pay capital gains tax and agent fees to exit. Now, some would view that as a negative, but actually it results in a much more stable market. Nobody sells their properties when they see on the news that China's having economic issues. People obviously do that with shares. and that results in a much more volatile market. If we look at that volatility, the last financial crisis that we had was 2008. The FTSE All-Share Index fell by 32%. The property market fell by 8%. In 2009, the property market fell by a further 8%. So the total downturn was 16%. Now, going back to that example I used of 75% leverage, you can handle a 16% downturn. So long as your property is rented, you're pretty safe. And then obviously the market turned positive again, and now we're substantially beyond even the 2007 peak property prices. So comparing the two there, I know that my argument here is pretty heavily weighted toward property, but it's just my opinion. Okay, the importance of having a strategy. So there was a study done in 1985 of Harvard MBA students, and they asked that class who had, have you set clear written down goals for your future and made plans for accomplishing them? 3% had, 13% had goals, but they weren't written down, and 84% had no specific goals. 10 years later, they surveyed that same class, and the 3% were earning 10 times more than the 97% combined. Now, I suppose the moral to that story is it's important to have a strategy. You can change your strategy every day if you want to, but strategy gives direction. And that's what we help our clients with. When it comes to property, certainly historically it's been a do-it-yourself activity. You go and speak with your local estate agent, they sell you something, you hope that it works. We can help our clients be a lot more strategic in their approach. And I'm pretty sure anyone would agree that when you're more strategic in your approach, you're probably likely to do a lot better. And that's important. We are running a promotion for the show where we're offering to waive our initial advisory fees. So we're based in central London in the city, just near Moorgate Station. We always offer initial consultation. So it's a free meeting where we tell you more about us, we find out more about you, and we determine if there's a fit there. We don't engage with everyone, we can't help everyone. But people that we can help, we usually charge a fee at that point, which ranges between £500 and £2,500, depending on the complexity of your situation. The promotion we're running is we're offering to waive that fee. So our advice to you, which on average is about 10 hours work specific to you, on providing you with a strategy and a recommendation, free of charge. Now, we won't do that for everyone, as I say, because it won't be suitable for everyone, but anyone that it is, there's no obligation and potentially a lot to gain. Within the packs that each of you have, there is a brochure, but there's also a feedback form. I do quite a lot of these talks. I think this is the 4th one I've done in the last 2 weeks. So we do like to improve them. Usually they go for about 45 minutes. This is a shorter one. But if you don't mind just turning your attention to that feedback form now, the top of it is quite literally that, feedback. So be honest but nice, because I will read them. The bottom of that form is to take advantage of this promotion. So if you are at all interested in exploring the opportunity of what property investment could do for you, whether it be a major or a very minor part of your portfolio, then fill in that form. If you're already a property investor and you think there's any way that you might be able to improve from a strategic perspective, a property selection perspective, a finance perspective, then fill in the form. It'll be 5 minutes of your time to have a chat to see whether it's worth meeting, and we can go from there. So if you don't mind just filling that in now, and I'll keep talking. If you see anyone next to you that's not filling that in, give them a nudge because they're doing the wrong thing. They need to fill in the form. Some examples of success. So where some clients have done really well. So we like centrally located properties. This is a good example of some clients that bought in early 2015. There was an off-plan development in the Birmingham city centre. Mostly one-bedroom apartments for around 100,000. Our clients applied a 30% deposit over a period of 12 months. Oh, there's a typo there. Which is 30 grand. And they achieved a £50,000 return on their 30 grand. So those properties 12 months later were selling for 150,000. One of our clients bought 4. He sold 2 at completion. He took back all of his money plus some, and he still has the other 2 yielding about a gross yield of about 6.5%, which is probably about 10% on the fund that he no longer has in the deal. So that's a great example. Obviously, you can't achieve that every time, and I'd love to say it's because we were geniuses. It's not necessarily. The market did well over that time frame, but we were able to position our clients to benefit from the market moving in the right way. And if you look at these properties now, they're worth about 200,000. So the asset value was thereabouts doubled over a 4-year period, and they were very well priced, to be fair. Okay, so we've got lots of educational resources on our website. So you have a brochure there. I think we have about 100 hours of video, which is all free. We don't even take your details to watch it. I host a TV show called Proper Wealth, which is on Sky, and it's on all areas of wealth creation. Now, it does have a property tilt, but we talk about everything. And Property Question Time, we've got 14 episodes of Proper Wealth so far. Property Question Time, we're just about to film the 200th episode. And that is a panel of 3 property experts. It changes every episode, but I've done about 70 odd episodes now, where people actually send in their questions. So over the past 2.5 years or so, since we started filming this show, pretty much every question has been asked. So it's quite useful, and most people that have watched it have given really, really good feedback. So that's free on our website if you'd like to sink your teeth into that. We've won lots of awards, which is great. I think we've won 8 awards now in the past 2 years. So we have really established ourselves as the industry leader in what we do, which is nice to say. Another thing I'm really proud of actually is we have 0 negative reviews over a 5-year period. As an advisory firm with no negative reviews, you can look at any of the online platforms, it's all very positive. And I'm proud to say that because it shows that we've been doing the right thing by people. This is our advisory panel. So this is essentially where that advice comes from. So I mentioned about waiving our fees and providing you with a free strategy and recommendation. That's where it comes from. I've probably spoken enough about myself, but I am an FCA-approved person, which is important, I think. Ian is the head of our advisory panel. Ian was the head of a company called Val Williams, which is one of the largest surveying companies in the UK, up until when he joined us in 2015. He essentially ensures we dot our I's and cross our T's, and we're doing the best possible thing by people. Giles has been this for 20 odd years and is also an FCA-approved person. Gary started out as an IFA and then moved into property investment, and he's been involved in $500 million of property transactions in the UK and Hong Kong. Stefan actually used to work with me in the company in Australia and came over a couple of years ago and joined me as a director and shareholder at Nova. And Sam was actually my first employee in London and has worked really well, built through the business, and has also become a minor shareholder and director within the business. So this is where that advice comes from. We have a front office team, obviously, who will speak to you initially and see if there's a fit there. If there is, then we will engage with you and we'll put that work into helping you improve. So again, those forms give you access to that promotion. Right, so if anybody hasn't turned their attention to the forms now, please do. And does anybody have any questions? Just raise your hand and I'll repeat your question and answer it. Yep. Good question. Okay, minimum investment and lock-in period. Great question. So another very common question we get. I suppose the minimum isn't determined by us, it's determined by properties that are worth buying. Now, you could go up to Scotland and buy very cheap properties, but I wouldn't advise that you do that. Of the properties that we like, that we think makes sense as an investment, I'd say the minimum cash that you require is around £30,000 to £40,000 to be buying a good property with leverage, and that will give you a great yield. It will be a central location, it will rent every day of the year, and you can be quite confident in growth. So far as a lock-in period, property is a mid to long-term investment. So we usually recommend looking at property as a 7 to 10 year investment. However, going back to the example I gave, that client sold half of the 4 he bought a year later and did really well from it. So the time frame is somewhat determined by the market, because if the market moves in the right direction and you do really well, you can exit quite quickly. But you shouldn't go into the investment expecting that. Does that make sense? Really where you do well from property is generally in the growth side of things anyway. The yield is nice, but compound growth on property really adds up. Over a 10-year period, a lot of our clients have achieved 300, 400% returns on the cash they've applied. And that is very achievable. So you don't obviously get that over a short period of time. So it's worth holding on. In my opinion, it's worth holding on to properties because selling is expensive. Capital gains tax, agent fees, etc. Any other questions, guys? Yep.
Sorry, you mentioned that at the beginning, but do you only work with UK residents or investors?
No, we work with overseas investors as well.
In terms of arranging lending?
Yep, so we can do that also. So we can do expat mortgages, we can do overseas buyer mortgages, depending on their situation. But we do work with people all over the world. I'm actually flying out to Moscow tomorrow for a conference over there. I was in Cairo a couple of weeks ago. So yes, we do work with a whole range of people. To be honest, most of our clients are London-based because that's where we are, but we can work with anyone. Yep.
Son, 18 years of age, university student. Can I buy a buy-to-let property on his name?
You can. So the question was, he has an 18-year-old son, and can he buy a property in his son's name? The answer is you can, but your son's probably not in a very good financial position, I assume, given he's 18, and not many 18-year-olds are. Yeah, so given he would be a first-time buyer and is a university student, I assume with very little income, you probably struggle to get finance. But you could buy it with him, and then the finance would be based on your financial position. But there are ways around it. Quite a lot of people buy through companies and add their children as directors and shareholders. That's one way of doing it. I suppose the answer is yes, there is a way of doing it, and we can help you determine what the best way is.
Right, I have a company, so I can appoint him as a director.
You could,
shareholder.
potentially, yeah. Yep. Yep. Yeah, good question. Indicators of where to invest determined by rent and growth. So we like central locations because we like areas with depth. So facilities, amenities, infrastructure, employment, large tenant pools, and depth in each of those areas. That's what mitigates risk. So we like major cities. Cities like Birmingham, Manchester, Liverpool, major infrastructure going in, very strong population growth, strong economic growth. They're the cities we've been focusing on for the past few years. I suppose it's about looking at what drives the property market and investing in areas that have as much of those factors as possible. Does that make sense? Does that answer your question? Yeah? Last question, yep. Yep. Commercial property can be good. The restricting factor with commercial property is the loan to values are lower, the interest rates are higher, and the vacancy rates are much higher. So if you buy a commercial property, and usually good commercial properties are expensive, you're committing to either a large amount of cash or a certain amount of debt repayments without the confidence it's definitely going to rent quickly. So the quickest answer to that is you probably need to be in quite a good financial position to make that work, or to take on the risk of making that work. Okay, guys, I'm going to get pushed off now, but the feedback forms, if you don't mind either handing them to my colleague on your way out. I think I'm the last talk for a little while, am I? Yeah, so everyone needs to leave anyway. So if you just hand them to my colleagues, you know, they look a bit like me, they're in their suits and the ties. And yeah, if you've got any one-on-one questions, feel free to come up and ask. We've got the stand just out on the next level. Great, thanks very much, guys.